Let's move on now and think about the income statement. Okay? So now we're going to talk about financial ratios that we're going to calculate using data from the income statement. The first thing we need to think about is what does the income statement measure? Okay? Here you have an example of an income statement for DirecTV. Okay? First thing is there is this term LTM, which is defined here in the bottom. What this means is that it's the data for the latest 12 months. So if this is March 31st, 2015, what this means is that you have the data from April 1st of 2014 to March 31st of 2015. Okay, so it's a year, right? And in many cases, the most current data that you can get is going to be a latest 12-month figure, right? So essentially what you have in the income statement is data on profits and costs. So you have revenue, right? You have costs, you have profits, right? And so the key information really that you can get from the income statement is profitability, how profitable a company is. Okay, the income statement is the statement that is going to give you that information, right? There are 4 profitability ratios that we're going to discuss. The asset turnover, they are defined here: asset turnover, net profit margin, return on assets, and return on equity. And you can see that for some of these ratios, we are going to use this important measure, which I call OPAT, okay? Which is operating profits after taxes. OPAT is defined as operating income minus taxes, okay? And as we're going to discuss next, OPAT is a really good measure to use when you are trying to figure out how profitable a company is, okay? The return on equity measure, which is measure number 4, uses net income instead of OPAT. So we're going to talk, the first thing for us to talk about is what is the difference between OPAT and net income. And to do that, let's look at Cablevision income statement again. Okay, so here you have the latest 12-month figures. Okay, let's use those, right? You have revenues, costs, profits. Operating income is here. It's at the top of the income statement. Okay, that's the key thing. Operating income is right there at the top, so it only includes operating revenues and costs. Okay, so revenues and costs that really have to do with the business, right? For a company like Cablevision, they sell digital TV and internet, right? So these are the revenues that they get from their customers, and those are the costs of operating the company, right? Operating income is going to be a measure of that. And then after that, we're going to have the non-operating expenses and revenues, right? So we have interest expense, we have interest income, okay? And you can see here that there is a net interest expense. That's the amount of interest that the company paid. So your net income is going to be a profit figure that is reported after interest payments and other non-operating items. Net income is at the bottom of the income statement, okay? If you work out the math here, right, what would be your OPAT? Your OPAT would be the operating income minus taxes, right? I've done the calculation there for you. So the OPAT for Cablevision in this latest 12-month period would be $764 million, right? And if you do the math, you know, the interest is the interest is 580 million. So you can check that net income is approximately OPAT minus interest. The difference between OPAT and net income is mostly that net income is an after interest measure. Okay? So what's the right way to think about that? If you think about OPAT and ratios that are based off OPAT, like ROA, what you're going to be doing is measuring profitability for the company as a whole, right? So they are up there in the income statement. For Cablevision, for example, you're measuring the profit for the entire company. If you use net income or return on equity, you're going to be measuring profitability from the perspective of shareholders only, okay? Because net income is a profit measure that is reported after interest, and ROE is a financial ratio that is based off net income. So we are not going to be including, essentially, we are going to be deducting interest payments and other non-operating stuff from your profit measure. Okay? So this might be okay, but as we already discussed a little bit in this course, net income is at the bottom of the income statement. So one problem is that net income is easily affected by accounting manipulation and one-time items, right? So if the company has a one-time expense, like a legal settlement, for example, if Cablevision gets sued in a given year, that has to be reported in your income statement. It's going to reduce your net income, right? And there are many ways that companies can manipulate the accounts to change your net income. Operating income is usually a more solid measure, okay? So for many companies, ROA is going to be a better measure of profitability than net income because of these two reasons, okay? It computes profits for the entire company, and since it's at the top of the income statement, is a measure that is a little bit harder to manipulate than net income. And here comes a question for you. Right? We talked about using the market value of assets and the market value of equity to compute leverage ratios, right? We just did leverage ratios, and there, if you want to figure out how solvent a company is, we have to use the market values, okay? Now we are computing profitability ratios, right? So for example, just to give an example here for you to understand what we're talking about, ROA is going to be defined as OPAT by assets, right? And the question is, should you use the market value of assets, right, or the book value to compute profitability ratios? Okay, so think about that for a while. The answer might be a bit surprising, but it makes a lot of sense once you think about it. To compute profitability ratios, you actually want to use book values. Okay? Why? You want to compare profits to capital that is invested in the company. Okay? And remember that a company's market value is going to measure the company's total value, right? It also includes the value of future cash flows. Okay? So it's not really a measure of how much capital has been invested in that company. It's not a measure of how many dollars investors put in that company. It really is a measure of the value of the company. Okay? One way to think about this, let me go back here, because this is an important idea. Okay? If you use market values to measure profitability, what you would be doing, right? So in the numerator, you have current profits. In the numerator, you'd have something like current profits. If you use market value, remember, the market value of assets is going to depend mostly on future profits. Okay? So you're going to be dividing current profits by future profits. Does that make sense? Not to me, right? So a company that is profitable, suppose you find a company that has a lot of future profits, okay? That, and you use market value of assets, this company is going to have low profitability ratios, but it would be unfair to call this an unprofitable company, okay? So this is a ratio that really does not make that much sense to me, okay? If you want to compute profitability of the company, you have to use book value of assets and book value of equity, if you can, in the denominator, okay? Let us now give some examples for Cablevision and DirecTV. Here I have a simplified snapshot of the Cablevision balance sheet for you again. Okay, so you can see the value of assets. We already computed OPAT, which is down there, right? OPAT for Cablevision is $764 million, right? So what you need to do is divide OPAT by the total value of assets if you want to compute ROA. So the value of assets is here. That should be very simple. Cablevision ROA should be 0.11. Okay, and you can get the data that I provided, and of course I will provide these calculations as well for you. So you can get the data and verify that you can get these numbers, which should be really easy to compute. All of them using the most recent data: asset turnover, net profit margin, ROA. Okay, let's think about ROE. Right? ROE, let's go back here again, okay? ROE is what? ROE is net income divided by equity. And remember, do we use market equity or book? Book, right? We just learned that. So you would need to use book equity. But we know that book equity for these companies is negative. Okay? Book equity for these companies is negative, right? So you really could not use ROE to measure profitability for Cablevision and DirecTV. So it's a measure that does not make much sense. It wouldn't be very useful for you, okay? And it's, you know, this is a common problem. Book equity is a problematic figure to use, and that is why, in general, I prefer, okay, I prefer to look at profitability measures that measure profits for the company as a whole, like ROA. ROE is going to have problems, okay? Finally, let's talk about earnings per share. Okay, this is a profit measure that we talked about in the beginning of this module already, right? It's essentially net income divided by shares outstanding. It looks like a stock price, right? But it's based off net income instead of the market value of equity, okay? And we discussed already some of the problems with net income, okay? So, of course, you're going to have some of the same problems as ROE because you're basing your profitability on net income, which is after interest, so it does not compute profits for the company as a whole. It is subject to manipulation and all that. It's affected by one-time items, okay? In addition to that, there is an additional problem, which is that you are dividing net income by shares outstanding, okay? And as we already discussed, shares outstanding can be easily manipulated. It's very easy to change the number of shares outstanding that a company has with something as simple as a stock split, okay? And then, of course, one thing you could do is to adjust your profitability measures, try to get at the actual profits, but, you know, it's much simpler just to not use earnings per share to compare profitability across firms, okay? You know, so my recommendation is that we do not use earnings per share to compare profitability. You know, since the number of shares can be easily changed, you know, it's not, we're not going to be able to say that a company that has higher EPS than another company is more profitable. Okay, so EPS is not a great measure of profitability, at least the way I see it.